So welcome to this Northwest Regional Investment Roundtable with Blankstone, Sington and IPSX in association with Professional Liverpool. I'm Stephen Cowperthwaite. I'm Managing Director of Avison Young in Liverpool, and it's my pleasure to be able to host this event this afternoon. We've got a diverse audience from across public and private sector, a mix of investors and developers from the property world, and investors who may not yet have dipped their toe into property. We've also got a fabulous panel of speakers who will be considering the options that investors have when thinking about returns, the need for inflation-proofing portfolios, and how diversification into real estate can assist. We're going to look at trends and the wider market outlook for real estate, and the benefits that real estate as an asset class can offer to investors, the merits of investing in property as part of a diversified portfolio, and consider the various different options available, including the benefit that single real assets offer investors in terms of performance, liquidity, and much needed investment yield. We'll also look at pandemic Liverpool and the opportunities this means from a local property market perspective now and for investors in the future. And of course, we'll consider how IPSX is offering a new possibility at a very local level for investors to access property as an asset class. It's a fantastic day to be bringing you this panel. Straight after this event, I'll be heading over to ACC Liverpool for the Good Business Festival's Change Business for Good event, which is the UK's first major face-to-face business event to be staged as part of the government's recovering planning. A great example of Liverpool leading the way yet again. We got 6 panelists. It's going to be a fast and furious question time approach. So I'll be doing my best Fiona Bruce impression to try and keep things moving along. And without any further ado, I'll introduce our panel. So we have Roger Clarke, Managing Director and Head of Capital Markets at IPSX, Neil Blankstone, Director at Blankstone Sington, Julie Johnson, Chair of the Commercial District Liverpool Bid, Mike Foster, Research Analyst at Hardman and Co, Professor Michael Parkinson, Ambassador for the Heseltine Institute for Public Policy, Practice and Place at University of Liverpool, and last but by no means least, Helen, Legal Director at Brabners. We're going to kick straight off with Professor Michael Parkinson, who's going to give us a little introduction discussing how Liverpool is adapting post-COVID, what the future looks like for the city with recent announcements such as the Freeport status in mind, and which sectors are showing potential for growth. So, Michael, over to you.
Thanks, Stephen. Good morning. Great pleasure to be involved, especially since Michael Blankstone was very supportive of my family over many years. So I'm grateful for his support. I'll speak quickly. 8 questions. What I was asked to do, why me? What are the recent achievements of Liverpool? What's been the impact of austerity? What's the impact of COVID? What's the impact of colour? Where is Liverpool now and where's next? What I was asked to do, paint a big picture of Liverpool's economic performance and prospects. Long story short, time getting the turn right, Pollyanna and or tricky, but the story of Liverpool in recent years is a successful, if partial, remaking of a post-imperial city. It has been an extraordinary example of economic placemaking. There is much done, but there's much to do. The financial mechanisms we're talking about today, I think, could be a very helpful contribution to Liverpool's future market sector development because of constraints on public expenditure. Why me? I wrote Liverpool on the Brink 30 years ago, the collapse. I wrote this book last year, available in all good bookshops. The fantastic renaissance of Liverpool. I've written about COVID and I've written about colour. I'm also a citizen of honour, so I tend to be a bit Pollyanna-ish. 3, the achievements of Liverpool. It's been a fantastic recovery the past 30 years. World-leading companies have made major investments, a transformed waterfront, a booming port, a massive visitor economy, a hugely improved business district, a far better retail offer, a rapidly developing knowledge quarter, expanding advanced manufacturing life science sectors, a hugely successful cultural offer, universities growing and more engaged in city regional affairs, the population growing again, younger, more diverse after decades of collapse, We're out back over 500,000. So driven by national policy, Heseltine New Labour, Europe, Objective One and Capital Culture, but the private sector, particularly in 2008 with Liverpool One, huge investor, the demand for resi culture and retail, and the growth and knowledge economy. The place is better, the people are better, I think the leadership and politics are better. The impact of austerity, we had a very good boom, but a pretty decent bust. The rock didn't slip down the hill. It did slow the growth, it did open up gaps, and it did put pressure on the local authorities' revenue, which means it's now the city's capital rich and revenue poor. Again, I think that's where you can play a part. The impact of COVID, the economy of Liverpool and its underlying health conditions made it especially vulnerable. There's been a big impact on the softer side, the visitor economy, retail, culture, sports, hotels, restaurants, airport, which drove Liverpool in the boom. But the harder bits of the economy have actually done very well. In particular, the health system is now a world leader. It's a national leader. It's connected to Knowledge Quarters, Connect University. It's going to be a global success. So we're now leading. So out of some very bad news, some good news comes. So I think health, digital, and the potential green. The city has a recovery plan and good leadership running it, so I think that's good. I don't want to ignore the recent report by Cala on regeneration Liverpool. There was some serious criticisms, but let me remind you about this. There are many reasons to be cheerful. The City Council accepted the report, is not in denial, confined to one department. Most local authority servants and staff are applauded for their good work. The key figures involved are either no longer employed or serving or involved in police matters. It concerned a very small number of deals with local developers, not with the many huge investments of recent years, which are all absolutely trouble-free. It's clear the CEO's got the support of government. He's already making necessary internal changes. And I think government oversight, they're not really taking over. Its oversight will actually strengthen reform and improvement. Government still supports Liverpool. It's the poster boy on health and emerging from the pandemic. Steve's already told you where he's going this afternoon. Julie, there's a big tent outside our house where Blossom are playing free in the park just to test all this. The nomination of Freeport, it's very helpful, not a silver bullet, but certainly a good club in the bag. The approval of the major investment of Brabners Port by government, or not calling in, hugely significant. And so politics are better. Where's Liverpool now? It's not back on the brink. It's much stronger than the 80s despite some recent issues. The economy is stronger and more diverse. The Labour Party there was in conflict with government. This Labour Party isn't, whatever the tensions. And very importantly, then the private sector had abandoned Liverpool and the City Council. This City Council, I think, in this city has very much more involvement and support of the private sector. And I think that's showing confidence and leadership, and that should help you. We've got to improve our place quality, invest in buildings and infrastructure. This tool could help. We have to increase our productivity. For that, we need better infrastructure and offices. Again, this tool can make a contribution. So it could be helpful. So where are we going next? My final 1 minute. There'll be some short-term reputational issues about Cala report, but I think we've hit a bump in the road. It is absolutely not the end of the road for Liverpool. We should remain confident about Liverpool's future. It remains investable. There is value and growth in Liverpool. There are still gains to be made. It's not at the top of the market yet. The long-term fundamentals are the same with all their strengths and their challenges. I think the opportunity and need for better office space, infrastructure will only grow. Post-COVID, I think cities like Liverpool will benefit from north shoring. I think city centres will be back, cities will be back. As Robert Krugman said, 2023 will be like 2019, only slightly less so. So I think history shows Liverpool have got a way of finding a way. So my judgment is we've made too much progress, there's too much to build upon, there's too much quality investment still coming on, and too many people and partners determined to make the place succeed for it not to be a really investable proposition. I think Liverpool should be confident, ambitious, treasure authenticity, remain internationalist and outward looking, keep its nerve and going for quality. And I think this initiative and this audience could play a very helpful part in all of that. And Stephen, I'm done.
Brilliant, Michael. A great introduction, and some of the comments that you made there: confident, investable growth, the fundamentals being in place, global leading is exactly what an investor wants to hear in the context of looking at property as an asset class. So that's a great scene setter for us from a local perspective. We're going to just zoom out, but before I do, just some housekeeping. You're bound to have some questions as we run through, so the Q&A function is available at the bottom, so feel free to post any questions in there, and we'll do our best to try and pick them up during the course of the afternoon. So we'll zoom out a little bit and come across to Mike Foster, research analyst at Hardman & Co. Who's going to provide a short overview on the real estate market and an update of performance of the listed REITs. So, Mike, over to you.
It's a very good intro, and follow that. I think that it's very realistic as well as Pollyannaish. I'm not going to be Pollyannaish. I'm afraid I'm going to be accurate with various eggs. In the stock market is where I've come from. I was a fund manager for a number of years, and then a property sector analyst. And as we're participating in Northwest Regional Investment Roundtable, I thought that I'd start off with looking at the regional quoted real estate stocks. And stock markets really do go up and down, and it can appear, looking externally, that it's slightly a random walk, and clearly it's been a very volatile period, and that period, frankly, is the past sort of 30 years. If you can bear with me, what I'm trying to show with this slide, and the details aren't that crucial, is that we're looking at half a dozen or so of the regional REITs, and we're trying to work out whether or not their pricing is rational or not. Total asset return is the growth in the NAV plus the dividend, and I've gone over a 5-year period, and PE is the price of that stock compared to the earnings in that particular year. And what we have is that the more highly rated stocks, that's the ones high up on the vertical axis, have also been the ones that have had the highest asset return average. So Picton, for example, is highly rated because it's produced a good set of returns over the past 5 years. So there is some rationality. The stock market can always say that, we're looking at pricing, and it's not a perfect scatter, but it's always got in mind the rational way of things. But the question is, what is it looking at? So first of all, the PE, that's the price on this particular year's earning. And what that's saying is that it's just looking at this 1 year. If you look at the price to NAV, is not so good a scatter. So the stock market is actually being quite short term. It does look at it almost year by year. And what we've also got is, I've not shown here the NAV because it's not so good a scatter. All these stocks are trading at a discount to net assets, even though some of them have actually produced quite decent returns. And this brings us on to the broader points. I think, if we move on from this, which is just trying to show that there is some sort of rationality in picking stocks, it's saying that the regional stocks are out of favor. And that's partly because they are seen as a small brother to the larger stocks like Land Securities, British Land. And what investors can see there is that over the past 10 years, both those stocks have gone down. I mean, British Land has seen a 10% share price fall. Okay, you've had some dividends. Land Security, 12% share price fall. If you look at the past 30 years, British Land has doubled. Land Securities is hardly up. So investors are kind of saying, really, we need to be convinced. We need an active, positive reason to invest in real estate stocks. Otherwise, we're just going to trade them at a discount. So there is, again, coming back to the rationality side of things, there is a rationality to the most of the real estate quoted stocks trading at discounts to NAV, because investors have seen that over the long period, they've just not really actually been that efficient a way of participating in the upward movement in assets. Even if you look at the most highly rated one, Segro, which is invested and is very well run in the very attractive logistics sector. Again, if you look at this 30-year view, I think it's good having a long view. It has gone up, but it's gone up by only 160%, which over 30 years, given that it's currently really in favor, isn't that exciting. So Hardman a couple of years ago looked at, what sort of areas would be more sensible and more attractive and more secure to invest in. Private investors might be looking for a combination of income and capital growth, but income is very important. And in fact, the stock market over the past 5 years, but particularly over the past 3, has been very focused on this security of income and also transparency. There's a group of just under 20 REITs quoted on the UK market, which we would see as secure income REITs. They tend to be single asset class. So typically it would be things like primary health properties, and the clue is in the name. They invest in GP surgeries, nearly 3 billion market cap. That's been going for a while, but there's been more and more of these sorts of single asset class stocks that are focused on sustainable income, the income coming predominantly either from government or from really sort of grade A tenants. And these stocks, of which there's about 20 or so, have actually been raising significant amounts of money. In 2019, they raised 1.4 billion. The average fundraise was 120 million. So reasonable size individual raises, but a lot of them. And in 2020, and here's the telling point, they raised 1.5 billion. So you had investors, again, I think being quite rational in saying that there was actually an increasing need for income, an increasing difficulty in finding secure income. And they put slightly more money into this real estate sector in 2020 than in 2019. And it's performed pretty well. If you look past the past 2 years to today, this bundle of secure income REITs, which are predominantly transparent because they have a single asset class that they invest in and they don't trade, it's a buy hold strategy. So this package has gone up in share price terms by 12% over the past 2 years. Now, admittedly, the broader real estate quoted stocks have also gone up. It might not feel like that, but they've gone up by 4%, but with much more volatility. And if you remember 2 years ago, the broader stocks are already at a discount, under pressure because of Brexit, because of the real problems that we were seeing in retail. So actually the starting point kind of favors the broader stocks, and they've still underperformed both in capital terms and also in income terms. So I think time being precious, what I'm saying is that there is a lot of volatility and a lot of skepticism in the stock market about the quoted sector, most of them trading at, frankly, fairly chunky discounts to NAV. There's a broad range of stocks which has raised 1.5 billion a year in the past couple of years, good times and bads, which is focused on dividend income, transparency, efficiency. They have low cost ratios to assets because they don't, chop and change and try and develop, they buy and hold. And this sort of sector has been very much in favor. So I think that raises some broader points, and this is a broader discussion, but it does pertain very closely to IPSX. So I think I'll leave it at that because time is short. Thanks very much indeed.
It's a tough challenge to try and do all of that in a couple of minutes. So thank you, Mike. So given that overview, Roger, we'll come to you now from an IPSX perspective in terms of how you can help investors who are interested in this as an asset class. I think, Mike talked about transparency and efficiency and liquidity. So you can cover that and how professional and retail investors at the local level can access these through brokers like Blankstone.
Thanks, Stephen. I think, and I am going to be very brief, but there's 3 quite interesting things Mike just talked about that I want to reflect on as they apply to IPSX. The first was the fact that the higher rated stocks, the better performing stocks, tend to be ones with good earnings performance, and earnings obviously comes from cash flow, cash generation. So clearly people want income, and that stands to reason. I'm going to now trump Mike in his 30-year view. If you actually look back over the last 75 years, the total returns that come from property in the UK of just under 10%, splits out as 2/3 from income, 1/3 from capital. So it's all about income. It always was, it always will be. Secondly, I think it's interesting that those stocks Mike was looking at tend to trade at a discount to NAV. Now, I would say that's largely because, to pick up on Mike's theme of the curate's egg, if you have a portfolio, a diverse portfolio, the problem is that as well as the costs of paying for and running a company that owns it, every year that something does well, something else you've got does less well. There's a kind of, you know, trend to mediocrity, if you like, a trend to what we call in financial markets beta. And yeah, you do see structural discounts, but as Mike pointed out, focused single strategy modern REITs don't trade at a discount. I want to scotch very much, and I'm going to slightly disagree with Mike here. Listed real estate doesn't trade at a discount. Old-fashioned, diverse, opaque, clumsy portfolios do. Focused, clearly articulated strategies trade at a premium, and that's why they're able to raise billions of pounds a year. So take that to its next level. Rather than focusing on companies that have portfolios that are homogenous, how about focusing on companies that just have one asset, and you just underwrite that one asset? Next week, we're launching our first IPO on IPSX. It's a building in Birmingham called the Mailbox, and you can look at all of the information you need to look at for one building. You can therefore begin to predict its future cash flow performance and its future asset management plan and how that's going to lead through to capital growth. And you can do that for one building. If you buy shares in the Mailbox, the returns you're expecting from that one building, which by the way is a 7% dividend yield on day one and a 20% IRR at the asset level over 3 years, it's not going to get contaminated by something else that isn't performing so well. You can choose one thing. And to pick up on that point about transparency and low cost, it's a pure corporate wrap around one building. And we're going to roll that out. We have a building coming in Leeds shortly afterwards. We have a building coming in London. And I really hope we have a building that we're talking to the owners about in Liverpool. And these are all going to be companies that you can buy shares in. Neil is one of our first members of the exchange, Blankstone Sington, and Neil is very busily collating orders for the Mailbox at the moment. And you can buy and sell shares in a single building. It's going to change how you can buy real estate. It's going to make it more transparent, lower cost, very liquid because it's a stock market, and you're going to get the returns you want rather than having to deal with these NAV discounts. So that's what IPSX is changing, and it's going to start next week.
Brilliant. So old-fashioned opaque equals discounts, and focus clear premium value, but we've also got focusing on that single asset. And as you said, that gives a real clarity and access to capital growth. So, and there's an interesting link there in terms of Mailbox being the first one, because Milligan, who developed the Mailbox in Birmingham, also developed the Met Quarter in Liverpool. So there's a nice little link between the two cities for us. So Neil, your chance to offer a response and consider this from an investment management perspective, and why, as Roger has said, you're already at work with IPSX.
Yeah, as much as anything, and thanks for today, and thanks to everyone who's joined us. The important thing for us is it's recognised as part of investment management that property as a sector plays such a vital role. Mike Foster alluded to it, Roger confirmed it in terms of the returns and the way that they're generated, so that 2/3 comes from income and 1/3 capital, if you like. For me, the attraction on IPSX is that we are talking about single asset REIT companies, so that again, Mike mentioned it, there should be a much closer share price match than a broader REIT because of all the reasons that have been stated before. The risk, which is always obviously something that we have to consider, is that it is a single entity, so that the balancing act that's provided by the broader entities has to be taken into consideration. And therefore, for investors, we do have to make sure that it sits within a broader portfolio. But I'm particularly excited, I think, as Mike Parkinson very kindly alluded to, that this is an opportunity and a way for us to reach out to the local market, if you like, and local investors in particular, in a way that's not been able to be done before, so that If you could imagine, from the smallest retail investor all the way up to the larger institutions, investing into a local asset is going to be far, far easier, much more interesting, and for them, much easier to understand. Imagine if you walk past a building that you are very, very familiar with. You talked about Beckwater as an example. You go in it, you can see how it's doing. So as a shareholder, that's almost an invaluable piece of information that you can judge and consider for yourself in terms of investment. And realistically, stock markets, again, Mike alluded to it, they're not perfect, but they're certainly my preferred way and our preferred way at Blankstone Sington of investing in property. We've seen before very, very recently, we certainly saw it in 2007 and 8. We saw it again in the last 12 months because of COVID. The open-ended property funds struggle because ultimately property as an asset class itself, as an asset, it isn't liquid, it's a physical building. So being easily able to raise funds or whatever else is far more difficult. So we've always favoured closed-ended. And part of the reason is because at the end of the day, it provides for investors an ability to get an attractive, relatively easily measurable return in a highly transparent way. And where there should always be a reflective two-way price, that definitely has attraction. I think the last thing to say is, from an investor's point of view, there are tax-efficient ways to invest. At the end of the day, for private clients in particular, you've got your ISAs, you've got your SIPs, you've got CGT allowances that can be used. So there's lots of different ways that you can consider how you're going to actually invest in property. And then obviously looking at it from the attraction of both developers and investors, there's a way to marry up the two. This is an easier way for someone, for example, who wants to get involved in property, maybe doesn't quite know how they're going to do it. Why not start with your local buildings or sector or whatever it is that's going to be brought to market, so that you can dip your toe, get involved, see how it works, see what sort of returns you can get, and go from there.
Brilliant. As we've already heard from Michael at the start there, then Liverpool is very much on the up with that potential for capital growth as well. So you mentioned liquidity and transparency, and this kind of moves neatly on to Helen from Brabners. Just maybe, Helen, you could look at that short and longer term positions when we're thinking about real estate investments and the importance of flexibility for investors. And as an added question, I'm going to ask you to just pick up one of the Q&As that's come in around planning and changes the planning process and what that might mean as well.
Okay, thanks, Stephen. I'm just scribbling that down so that I pick up on everything. So investment into real estate. So I'm a real estate finance lawyer, so I'm quite involved in investing in real estate and also structuring the finance that sits behind it. So when we look at investment into real estate, it's generally made for one of two reasons, either long-term investment or as a trading asset. Okay, so we've already heard a little bit from Mike about income and capital growth and secure income REITs, and they're what I would call an example of a long-term investment, which is based on returns from the asset during its lifetime as a whole. So this is a longer term view and is traditionally the way that you invest in stable assets, where there's an existing building potentially let on a long-term lease to a tenant with good covenant strength. So think, for example, about the Amazon sheds near Manchester Airport, that will be your stereotypical secure trading assets. So we're thinking warehouses and sheds, health service providers, as well as residential ground rent investments. Those are the sorts of things that would traditionally fit into this category. Okay, so trading assets are one where the life cycle of the asset is going to be a little bit more involved. So we look at a life cycle for those sort of assets. We acquire, we develop, we get planning, and then we let on and we sell. So that a lot happens with a trading asset. You look at different returns at different stages through the process. when we think about the two different categories of assets, so those stable assets and then the trading assets, Mike's talked a lot about income. So where does that income come from? Is it purely just rent, or is it actually a return on the investment? And what that brings us back to is the key point for the investor is, what's their exit strategy? How at the end of the day are they going to get their money back? So on an investment asset, one of those secure assets, that will only be by dividends on income derived from the rent during the term, with the capital being repaid on an eventual sale, which, depending on the purpose for which the property is held, might not be for some time. So these are lifetime assets that we're talking about, which are generally invested in by pension funds because they are so stable. Nothing happens with them, they sit, and there's a guaranteed return. But that doesn't work for everybody, because you might want to get your money out sooner rather than later. You might not want to be in it for the next 100 years. So on a trading asset, we look at opportunities for that exit to come sooner. For example, on a quick disposal after you've increased the value of a property following planning permission having been obtained. This is a great, there's a lot more flexibility. There are a lot more positions for exchange, positions to exit the asset following an upside. But the problem is, if an investor is investing in part as part of a syndicate, a joint venture, or as a company's shareholder, there still needs to be an agreement between all of the persons involved in the investment in order to manage the exit. And this makes it a lot more complicated if people want to stay in past the initial uplift point to try to increase their return, when others want to get their money out. And as has already been discussed, this is where IPSX is looking to fill the gap, so that you can actually trade your shares rather than having to negotiate with everybody else who's involved in the scheme to exit at any given time. So it's important when you're making an investment to consider what that exit strategy is and what it means for you. Are you in it for the long haul, for that stable asset that's just going to sit in the background and pay you returns? Or do you want a shorter, quick return on your investment following a potential upside in the grant planning permission? If so, the way in which you invest, whether it be privately, joint venture, or something through IPSX, is really important to consider. So that's the property investment issue dealt with. Let's have a quick look now at planning. So I think the question was about the proposed changes to the planning process. Now, my planning colleagues have written at length about this, so I'll do a quick plug on the Brabners website for that, because there's a lot been published there. That's my quick plug for the day. But the introduction of all these planning changes, and also use class E, which has been brought in recently, are all designed to stimulate the economy, particularly the high street. So historically, we've had all sorts of different use classes which are quite disparate. So we've had retail, financial services, light industrial, and those and others have now been brought together in this big use class E. And the reason it's been done is so that when you look at a high street and you've got historic shops that have been used for retail, there aren't as many retail providers at the moment who want to take that space. So retail leisure is very, very depressed, but actually there are other things, so culture, art, opportunities for people to meet, flexible working spaces, that all want to take that space and take advantage of the social distancing, which requires that we all have a little bit more space. Before the planning changes were brought in, it was a long, stodgy process to get that change of use if you weren't within a permitted change between the use classes. So part of the reason that we now have use class E, and also the other changes, is to stimulate the economy, to avoid empty rates having to be passed back to landlords who are already struggling, and to get more diversity of use within the high street and elsewhere, to try and sort of bring a little bit more life, I think, back into the world. So I think that the proposed changes are a positive thing. Hopefully we will take advantage of them, and we'll start to see some changes out on the high street and otherwise as a result of that. Is that okay, Stephen?
That's brilliant, Helen.
No worries.
Simplifying the planning process has got to be a good thing, providing that we don't lose the quality angle. I think, you referenced High Street there, so an opportunity to come across to Julie now to talk about what the bid is doing, and it gives us a nice little bookend in terms of, from Michael's intro and back to Liverpool now. So the work that you're doing in the bid, Julie, so that local level to stimulate the market, and what are you seeing in terms of changes, etc.
Thanks, Stephen. So basically the purpose of Liverpool bid is to improve the place. So it's enhancing and developing the bid areas and making them exceptional places to work in, live in, invest in and visit. So we've achieved this over the last 16 years by keeping our levy payers up to date with crucial business information and support and training. The last 12 months, businesses have told us that if we hadn't have provided them with some of that information, they literally wouldn't have survived. We keep the bid areas clean and safe. We want people to come to the city and see a clean and safe area. We've got 2 dedicated bid police officers, and we've got a team of street rangers who can do on-the-spot cleaning and scheduled cleaning as well. We collaborate with the city stakeholders as a voice for business. So we've worked with them on the Liverpool Without Walls scheme, which has allowed us to open up our hospitality venues. And we're doing that safely in Castle Street and Bold Street. And if you haven't visited them, please do so. Our footfall numbers have increased since the 12th of April. We've had over 1 million people coming into the retail and leisure bid areas per week. This week, it was nearly 1.2 million. And that's in comparison to 2019 figures, we were looking at 1.4 million. So we're not that far off. The national town centre vacancy rate for Liverpool retail and leisure bid area in January was 6.7%. And we're booking the trends again. In comparison to the Northwest, it was 13% and 11.7% nationally. We produce the office market review annually with Professional Liverpool, and we work with a number of property agents to assist with the collation of the data. That's going to be out in May 2021. We are seeing, as Helen said, an increase in people wanting flexible terms, reduced sizes of retail outlets, but an increase in number. And we've had the benefits of the mixed economy and the mixed uses in buildings. We're seeing more of that. We're working with key managing agents and landlords in the city, and we've got some great examples already and increasing numbers of them too. This week, CBRE have announced they got 6 new tenants in the Royal Library building. There's plenty more of that to come. We've got big developments in Liverpool city centre. We've got the Melia Hotel opening on the 16th of August this year in Old Hall Street, right in the centre of the commercial district. We've got the Pall Mall development in the commercial district. That's just ready and waiting for development, and much needed Grade A office space. Now, the Grade A office space was a core need identified in the SRF in 2019. But as others have said, we can't underestimate the importance of culture in the city of Liverpool. We've worked with Culture Liverpool, Marketing Liverpool, and many others to animate our city and our districts. We've got the Light Night Art Festival on the 21st of May. We've got Liverpool Biennial, which is ongoing now. We've got Liverpool Plinth and St Nick's Church, and we've got our Christmas extravaganza. But we're also proud to say that we're expanding our bid area. So we're now expanding just from the city centre onto the waterfront and St George's Quarter as well. And that's going to give us £7 million of investment in the city centre over a 5-year bid term. And I can't go without saying that there's no place like Liverpool. And I would encourage any investors who've not been to visit our city to come and do so soon. Thanks.
I totally endorse those comments, Julie, absolutely. And, the culture and the quality of Liverpool as a place is fantastic. The development that you didn't mention there, I had the privilege of going around last week, was the Spine, which is due to open in September, and it's absolutely fantastic. And you watch out in the press for when the images start coming through. It's one of the few buildings I've been around where the actual building, looks like the CGIs, and it's probably better than it as well. I'll give Roger a heads up, then I've got to come to him because Julie's talked around, development opportunities within within the city. So we can cover that in terms of IPSX. Is it just for investment into existing property, or is there a development angle there? So we'll come to that one in due course. But I think we'll go back to Michael, as a follow-on from your opening remarks. And in terms of just exploring a little bit more how COVID has affected real estate and what we might see in terms of further adjustments across retail, office sectors, etc., from a local Liverpool perspective. You're on mute, Michael.
It's not like me to stop myself talking. I can't. That's usually my wife. Look, it's been a very difficult year. We've had a very bad hit. There's no point denying that. Liverpool city centre drove the economy a lot, and that was visitor economy, tourism, retail, softer stuff. How will we come out from that? I think there's a lot of latent demand. I think, frankly, what Julie was saying about already take up, people are coming back. So I think retail, visitor economy, tourism, culture, leisure, this will come back. Yeah, I think we're slow on the international front, but we haven't had huge amounts of that. So I think when we feel free at last, people will want to get out and about, and I think so. I'd be confident about that. Obviously, the nature of retail is changing anyway. COVID underlined that, online, high streets, all of that. So that's changing. So kind of what the impact on that will be, I think, is important. Again, I suspect, well, I know, quality will survive and lack of quality will not survive. So quality buildings, I think, will go, continue. Yeah. In terms of industrial, I mean, you follow the real economy, there's a huge amount going on. And I didn't make enough of the point that Stephen just made about the knowledge quarter. I mean, it is driving Liverpool City Region economy. There's massive, massive investment going in. Universities, local authorities, hospitals, private sector companies. There'll be huge demand, I think, for those kinds of premises, because that's where the economic dynamism is going to be. And then on the office thing, my line about Krugman 2023, but less so. For 50 years, people have said, we all want to work at home. We've all worked at home for the past year. We know it has some virtues, but I don't know anybody who says, this is how I intend to go on for the rest of my career. People will want, face-to-face decision makers, key decision makers, that's going to be face-to-face, that's officers. People want to meet again safely. I think quality, diversity, flexibility. So I think it's all to be played for. I think, as I've said, there are some weaknesses of the Liverpool economy, which I wouldn't deny, but there's some huge strengths: green, digital, industrial, advanced manufacturing, health, and culture. So I think there'll be demand there for those premises and for infrastructure support. And so I think, I'm now feeling much more positive about, where we'll be in 5 years' time than we might have been 1 year ago.
Yeah, absolutely. The city is not dead. And I think, that need for collaboration, mentoring, health and well-being are also important, and you don't get that sat at home on your own fundamentally. So, and I'll also just come back to how the city is recovering. So in Avison Young, we've got our own UK Cities Recovery Index, which looks at a whole range of different sectors. And Liverpool has bounced back very strongly in comparison and is above the national average in that context. And we've seen that consistently after each lockdown as well. So I think, we're already, without the tourism and visitor economy, the city's already bouncing back really strongly. And when we can get to a place where we add that back in as well, plus those growth in other sectors, then, we are in a good place. Mike, I'll come to you then as a follow-up in terms of that wider, the impact of COVID, what you're seeing from your perspective in the various sectors.
I think in the stock market, yes. And we've obviously seen, looking at it globally, it's actually quite an interesting situation, and obviously a tragic COVID outcome in India, but nonetheless, the markets, so almost no matter what's sort of thrown at them, are looking at the strength of global money supply. So I feel slightly bad to referring to India at all, but it's a good example of how investors are really looking on the sunny side of the street. If you look at all the major indices, they're pretty much at all-time highs. Funny enough, the UK is sort of lagging a bit, but we've seen big recoveries in some of the real estate quoted stocks that are seen as the riskier ones. Nonetheless, those that are very risky, like Hammerson, very much in retail, are still really struggling. And the recovery in British Land and Land Securities has been a lot, but from a very low base. So overall, I think investors are still more concerned at matching their need for income than about the risks of everything blowing up.
Thanks, Mike. Roger, I'll come to you, just picking up on the development side of things, as I say, and what IPSX offers from an investment perspective, and then maybe we can come to Neil as to thoughts of the investor, what they're looking for from an asset. Roger?
Yeah, thanks, Stephen. I'm glad you asked. So obviously earlier on I was talking a lot about income and income producing assets, stabilized assets. It's a key part of real estate, but it isn't the only part of real estate, and isn't the only type of financing that owners and issuers of companies need to look for. And we recognize that absolutely. IPSX is a market on which developers can raise finance. We have a market called IPSX Wholesale, which is only for professional investors, so institutions and professionals. And there are far fewer restrictions. Much higher loan to values are allowed, much smaller free floats for people who don't necessarily want to sell a lot of the asset at the current price. And in particular, the assets don't need to be stabilized and income producing yet. So yeah, we are certainly talking to developers. We're certainly talking to developers in the Northwest region about, I think the interesting thing for them is to perhaps, rather than just develop an asset, perhaps pull land through a land bank, perhaps build BTR apartments and then have to sell them, to be able to use our market to raise finance and build a vehicle and keep it and start to build a business rather than just doing property trading. So yeah, we can really offer any sort of owner access to capital, and we can offer any kind of capital return profile to investors.
Great. So Neil, what are investors looking for? What kind of data, performance data, is it that you need from?
As much as anything, there's probably a key word, we alluded to it before. It's stability of return more than anything else, but it's also then the liquidity and the ability, as Helen was trying to talk about, in relation to exit. So when you make your initial investment, you judge it on its merits in its own right, and then you compare it to something else in its own sector and then other sectors. So you look at it in broadest terms, and then you look at its relative value alongside other things. The key thing as far as it goes in terms of property is very much the anchors within the property itself, and then the sectors that it operates. And I think probably Roger has been very good in not overselling IPSX this morning. But I think the interesting thing is it won't just be about buildings. It will be about sectors as well. Michael's talked about a number of them. But I think the key thing is it's going to provide an opportunity for people to think outside the box a little bit, because of the way that we've all had to adjust. If you think about what you've done over the last 14 months and how we've all adjusted, maybe the way that the leisure sector, for example, we know, for example, golf has been a phenomenal explosion in golf over the last 14, 18 months, hopefully with council support and recognising the health benefits of that as an exercise, etc., etc., with golf being very much at the forefront. There's an opportunity, hopefully, in the golf sector to develop out many different ways and bringing that into the broad aspect of Liverpool and its community and opening it out to a much wider group of people. which then in itself, that should underpin then the investment, which makes it more attractive for us as investors into it. So stability of returns, attractive yields. You've also got the element, again, Helen mentioned it, that you can look at it on a constant basis. We call it competition for capital as an investor. And with enough investor choice, then there's no resting on your laurels almost. So the businesses themselves have to keep going. You can't get complacent about things because someone else will always come up behind you. And as a stock market with full liquidity, with the ability to trade fairly easily, you can move your property investments in a fairly simple way to maintain an overall portfolio. So I think what it will do, what IPSX in particular will do, is allow investors to look at it and work from both a broader national level down to a local level. I think looking at it, questions come in as to why Liverpool as opposed to Manchester. I think we have a very biased panel, apart from Mike Foster and Roger Clarke. We don't mind admitting that. For us, and for a lot of people in Liverpool, we are the centre of the universe. But in reality, why Liverpool is against Manchester, ultimately it has to come from the fact we are coming from a lower base. If you look at where we are coming from, but also remember where we have been, you can see the opportunity. Liverpool, of course, historically, if you go a very, very long way back, was enormous as an economy. It helped to drive the UK economy. We've never, I think, certainly during my lifetime, heard a Conservative government be as praising of Liverpool as it has been. And in reverse, we're seeing Liverpool politicians praising the work and the help that has been given. So we are coming from a very low base. The city has reinvented itself hugely, but it's not lost sight of who and what it is. As a city, we have a can-do attitude. We're determined to get things done. Sometimes we're a bit in your face, but other times we will listen and learn. The Cala report has proven that we can listen and accept where we've made errors. And I think there is an opportunity that Liverpool in itself hasn't had for an extremely long time, working from that lower base, lower costs, massive increase in skill set. If you think that the government is relocating, how many people? 22,000 potentially, is it, into India buildings? Just think of all the spin-offs for that. So there is opportunity in the different areas, which will give then ultimately, as far as we're concerned on the investor side, real investor choice.
Yeah, not quite 22,000, but 2,500, but it's still a sizable number into the city. But
ultimately, it'll be 22,000.
It will be, in terms of what it will bring to the wider business district, and as I'm sure Julie will point out for us. And Helen and Roger, really, how do we, valuing the asset? How is it valued? How often is it valued? And again, Helen, probably an opportunity for you to just elaborate a little bit in terms of, from an asset manager's perspective, what the assets, what are the priorities, from that investment perspective that you're seeing with your clients?
Okay.
Helen.
So, sorry, so all the things at once. No, that's fine. So generally we see assets valued about every 3 years on a tenanted property. Partly that's to make sure that your rent is market and everything is standard, to make sure your insurance is correct. And also if you've got a lender involved, that 3-year period is pretty standard. But having said that, in the last 12 months have taught us anything, it's that 3 years is probably too long, because anything can happen. I suppose the benefit to having a trading asset that is traded on something like IPSX is that valuation is constant, and you react to changes in the asset because of the way that this is marketed rather than the market. So the asset value, you've got your bricks and mortar value, which is one thing, but also your value of derived income, which is the rental income, but also your potential value. So for some buildings, they won't have a potential value, they have a standing value. So if we think again about those secure assets, you know, you share this with your long-term tenants, that's very easy to value. It is rent times term plus a bit of land value. And then, sorry to all my valuer colleagues, I'm very sorry about this. But in its simplest way, that's how you value it. If you've got a piece of land, it's very different, and that's where that constant valuation comes in, because at the moment I've got a piece of land, there's nothing on it. Okay, now I've got a piece of land and I've got planning permission to build a house on it. Okay, now I've got a piece of land with structure on it, but it's not quite finished, but it could go either way. Okay, now I've got that land with the structure, with the tenant, and that valuation, it's constant. And so your asset value changes. So again, it depends on, are we looking at a stable asset or are we looking at a trading asset? And it's up to the asset manager, when we come back to sort of to Neil's job, to look at, you know, what is the client looking for in their return? Do they just want that kind of the churn of the stable asset, or are they slightly more interested in sort of this more involved asset that has the potential upside, but obviously there are risks associated with that upside? You know, you've got build costs that go up and rain that comes down and all that kind of thing. So it's a great balancing act. There's a lot to do.
Yeah, Roger, over to you, and maybe give us a little teaser about what might be in the pipeline.
Yeah, I just to pick up on a couple of the points Helen made. So yes, it's true that IPSX listed companies will re-perform and republish a valuation every 6 months by a valuer, a red book valuation. But as Helen says, there's going to be a price every day, and that price will move based on what people think the value of that asset is. So now I'm not a property guy. I'm not trained in property. I'm a financial markets person. So to me, the value of everything ultimately is a discounted cash flow. Even something like Tesla is worth hundreds of billions because people think it's going to generate cash in the future, far more than it does today. So even something that is a hole in the ground, essentially you're valuing it based on what you think it can do for you, because otherwise it doesn't really have any particularly intrinsic value. In terms of Stephen, what we've got coming, we've got a pipeline, a huge pipeline. We've got the real estate industry is really behind IPSX. As an aside, we had a letter produced by the BPF, British Property Federation, back in late January, expressing public support for us as an exchange, as something that the real estate industry needs. And that, I think, so far has been signed by 45 CEOs or chairman or chief investment officers of property companies and property investors. And that is manifested by the fact that we've got nearly 40 conversations going on with people who own assets about using the exchange. As I said, next week we have our first IPO. A lot of people who don't really understand how stock markets work, and why would they? They're lifelong property people, are watching what happens next week with an incredible amount of interest, because they're going to begin to learn who's going to buy these shares, how are these shares going to trade, how often they're going to trade. And as that sort of playbook, if you like, starts to get published, I think that's going to unlock a big pipeline. As I say, 40 assets all across the country. Total value of them is well over £12 billion, which is an interesting number. I mean, £12 billion is over 20% of the entire listed real estate sector today. You know, what's taken the London Stock Exchange 300 years. And we're not cannibalizing that. We are just bringing different types of products along. But that shows you how quickly this market can grow and how much the industry needs it. We've got all sorts of different things coming, for different types of owners. I think perhaps in the context of today, maybe the most interesting type of owner to mention is we have a number of conversations going on with public sector bodies, both local and central, about ways, of course, to bring private capital more efficiently into partnership with public capital. The great thing about a stock market, for example, when you're thinking about value for money in public procurement processes, is that by definition it's been marketed universally. And also central government, clearly, when we started this a couple of years ago, central government was interested in talking to us, and the public finances are in a worse state today than they were 2 years ago. And so lateral thinking about how to raise capital and bring private capital partnership in is very high on people's agenda. So some really interesting stuff to look out for.
Brilliant stuff. And if you look at
can I just add from the investor's point of view that the other key point, of course, about IPSX as against, say, the peer-to-peer lenders and so on and so forth, is it's fully regulated. And the underpinning of that is absolutely vital, because that should hopefully give an extra layer of confidence to investors. Peer-to-peer lending has its place, there's no question about it. People are seeking more returns on their cash, but if you can actually physically own the asset, or if there's going to be debt that's going to be issued that could be listed as well, is very much more in favour for investors, that they have the full protections, be they through the FCA or the compensation schemes, should the inevitable, almost odd occasion arise where these things are required. So I think that's a really important point to make about IPSX in terms of its difference to some of the other forms of property fundraising at the moment.
Absolutely. We've run out of time. It's been an absolutely fascinating conversation, looking at both what IPSX can offer, the strengths of Liverpool as a region. One of the questions that we haven't got to is about whether the likes of Birkenhead, Southport and others, absolutely nothing is excluded in that context. So yeah, I think it's going to be interesting over the next few years. And you're absolutely right, Roger, is that, for the economic recovery plan for Liverpool to work, then it's not going to be public sector money on its own, and you need private sector alongside it. Absolutely. So this is a fantastic vehicle to facilitate that going forward. So thank you to my panelists today. Extremely well behaved. I think we covered a lot of ground in a short amount of time. Thank you to everybody in the audience as well. Any questions, do please get in touch with either myself or any of the panelists. Thanks for coming along, and have a great day. Cheers.